After a brief short-term downtrend in the market, the price initially climbs, taking support from lower levels. Yet, sellers push it down once more. This time, the price tries to break its previous swing low but fails and rebounds to its earlier swing high. This forms a double bottom chart pattern with a neckline resistance on the chart. In this pattern, the price reverses twice from nearly identical lower points, producing two bottom levels. That's why it's referred to as a double bottom pattern. Many traders also call it a W chart pattern. However, the emergence of a double bottom pattern indicates that sellers are slowly losing control, causing the price to fail in breaking its prior swing low. Once the price breaks this neckline resistance, new buyers step in, adding momentum and pushing the price upward in a double bottom pattern market. This pattern is seen as a sign of weakening sellers and is therefore used as a bullish reversal in price action. Let's dive in. But before we continue, if you find this content useful, smash that like button, and if you're new here, don't forget to subscribe and turn on notifications so you never miss our latest uploads. I'll see you right after the intro and disclaimer. Let's understand the psychology behind this setup through some chart examples. This is a 5-minute timeframe chart of Nifty 50. After the market opened, the price moved within a range for a while, then broke below this range and declined. However, after facing rejection at lower zones, the price bounced slightly and, after consolidating in this range, once again attempted to breach its earlier swing low, but failed. This created two nearly identical swing lows on the chart. Since both swing lows appeared near the bottom of the chart, we call this a double bottom chart pattern. The strength of sellers around this zone on the chart has now weakened, which explains why the price could not break this swing low. Let's now analyze why this pattern developed on the chart and what the psychology behind it suggests. Here, after the session opened, a double bottom setup was created on the chart. A long wick candle formed, and the price traded within this candle's range for some time before breaking downwards. This indicates sellers are attempting to drive the price lower. There is momentum to the downside, but the price faces rejection from lower levels, pulling back to the same area from which it had previously broken, creating a tweezer top candlestick formation on the chart, which signals a bearish reversal. Now, expecting the price to retrace from below and face resistance at this level to fall again. Some retail traders don't wait for this swing low to break and begin initiating short trades. The price drops for some time but fails to break the previous swing low and instead rallies back toward the swing high. This price action creates two bottom points on the chart, and a neckline resistance forms above. This neckline acts as the last resistance for sellers who have entered, as most of them have placed stop losses above this zone. Once the price rises beyond this level, these sellers panic and exit their positions. Buyers can step in as the price breaks this neckline from lower levels, forming a strong bullish trend as sellers weaken. When the candle clears this high, buyers look to open long trades. There are two reasons for buyers to initiate long trades here. If you draw a trend line connecting these higher lows, you'll notice the market has already broken this trend line. In addition, the price has cleared this neckline with a bullish candle. Considering these two confirmations, you can place a long trade here. The minimum target would be near the day's high. Our reward here is much larger than our risk, making this an ideal setup for a long trade. Soon after, the price continues moving in our trade direction and hits our target. We can take this trade at two opportunities. First, when the price breaks the trend line, we can enter an aggressive trade. Second, when the price pulls back to retest this level, you can enter by observing a bullish price action pattern on the chart. Here, the price found support at the neckline and formed a bullish 3 inside up pattern on the chart. A candlestick formation confirmed, so you can plan a long trade here by placing your stop loss just below the neckline. Shortly after, the price moved in our trade direction and reached our target. Here, we simply applied price action to read how buyers and sellers behaved on the chart. We closely analyzed the chart and used candlestick formations as trade entry confirmations. Therefore, if you want to be consistently profitable in the stock market, you must learn these methods yourself. Otherwise you risk falling into traps of fraudsters and losing your capital. Let's move on to the next example. This is the 9-minute timeframe chart of Nifty 50. Here, right after the market opened, the price dropped by more than 500 points, creating a lower low from morning until market close. Any trader who had purchased put options at higher levels here would have faced a significant loss due to this sharp downside move. However, some traders must have booked solid profits, and when they booked these gains near the end of the session, the price closed slightly higher. This is how swing lows appear in the market. On the following day, the market opened within this range and tried to break its earlier swing low, but before doing so, it rose back toward its swing high. This shows that sellers are no longer strongly interested in selling at lower zones, which is why the price reversed before breaking the prior swing low. After some consolidation, the price broke above the neckline resistance and closed above it. Now, by aiming for a 1 to 2 target from the close of this breakout candle, we can plan a long trade here by setting a stop loss slightly below the candle's low. Soon after, new buyers, noticing the resistance breakout, begin entering long trades. This adds buying pressure in the market, and the price rises quickly, triggering stop losses of sellers positioned above. By analyzing the chart this way, you can plan entries and exits in the double bottom pattern purely on price action. That's it, traders. Thanks for watching. Remember, success doesn't come to the fastest. It comes to the most consistent. Step by step, day by day, you get closer to your goals. If this video gave you even 1% more clarity, hit that like button. It really makes a difference. And if you're new, subscribe and press the bell icon so you're always the first to know when new content drops. Keep moving forward, no matter how small the step. I'll catch you in the next video.